and welcome to our special series, The Dream Decade. We're calling it Dalal Street's Coming of Age, a period where the Sensex surged from 2000 to 2008, a whopping 250%, where it lived through government changes, where it lived through corporate disasters, and where it lived through global financial disasters as well. At times it stumbled, and at times it sprinted, but at the end of the day, it seems to have stood tall. And at the end of the day, it seems to be Dalal Street's coming of age.
The most defining feature for equity markets in the last 10 years has been actually there have been two features. And feature number one would be the emergence of India as an IT superpower, that journey began a tad earlier than the last 10 years, probably around 98 is when Indian IT stocks and the sector itself came into global prominence. And then by 99 it was in full swing, so that was pretty much the foothills of the big climb for Infosys, Wipro, and entire pack around 10-12 companies. And that's the first time the world actually sat up and took notice of India by way of an industrial superpower. We were always known as the largest democracy, but whether we had any industry worth the name in which we could claim or lay claim to global competitiveness, till that point there was no industry that the world was really looking at India from that lens. IT was the first one, and that journey began in 99.
When we went public on NASDAQ in 1999, it was, the primary reason was to build a brand for Infosys outside India in the global markets, in the most challenging, most benchmarked capital market in the world, so that we can be compared against our peers for performance and things like that. So there were clear, logic and reasons behind those. First, of course, to invest in the business. Second, to build the brand.
And the second defining feature of the last 10 years has been overall the emergence of India as a sort of overall investment destination within the emerging market pack, along with, of course, the other three components of the BRIC pack. So the first phase was really one industry brought India into the limelight. And the second phase has been that the entire aggregate corporate India has itself come into the limelight of global money. So I think those two things will be the most defining features of the last 10 years.
Before that, India was, a third world country, not respected in the world, a traditional 3% growth rate. The world looked at us differently after our technology boys took off. And I think there's a person who doesn't get a lot of credit for this, but I think Jack Welch really set the cat among the pigeons by starting GE's back office work, technology work in India. But then it was run by the Indian boys, whether it was Narayan Murthy or Nandan at Infosys, Azim Premji and Suta at Wipro, or Mr. Kohli and Ramadurai at TCS. They really gave us a sense of pride in India, and if they hadn't done that, we would never have had the ambition to become a global Asian power like we have.
Actually, in the last 10 years, that means just starting from 99, technology had already done its bit by then, or maybe 98, but I think from a stock market point of view, the biggest achievement, not maybe 10 years, but 10, 12 years, 15 years, has been the fact of dematerialization of stocks in India, which allowed us to raise so much money from investors and to have the volumes that we had, without which none of these other positives of the market would have been achieved. So from a one big picture, big thing, now I'm not exactly sure whether it should be 10 years or 12, 14 years, but for me is actually the efficiency of the stock market trading mechanisms.
If you actually look at the technology of the Indian market, just in terms of processing trades, providing liquidity to the market, India is up there with the world leaders in terms of exchanges. So I think that I would argue that the capital markets, as they have developed so successfully in India, have actually been a very positive contributor to the economic development of the country.
It was a decade where some of India's biggest companies and the stock market's most successful stories seized the opportunity to hit the street and go public. Bharti, Maruti, TCS, all blue chips today were not so long ago selling their growth stories to eager investors.
Well, there has been a sea change in the way primary markets have evolved in India. In the 70s and 80s and in the beginning of 90s, we had controlled pricing, and so shares were offered at a very great discount, and it was a bonanza if you got some shares. Gradually, after we came with free pricing and then demat and screen-based trading, we found that pricing of issues has become more international style with a small discount to what people think would be the market price on listing. So obviously all that icing in the cake has gone. On the other hand, issuers are very excited.
And at times, a little too excited.
I had one guy, I will tell you, one investment banker was asking me to invest in an IPO, as a fund. And I said, have you invested personally? He said, understood. Understood, sir. So what does that mean? He knows it is wrong.
And I'm afraid even government is guilty of that if NHPC is any indication. And secondly, and very importantly, there is no feedback to the lead managers in a proper form that they were doing the wrong thing.
From 6,000 in the year 2000 to 20,000 in the year 2008, the market was growing in leaps and bounds. More money, more IPOs, and thankfully enough, no more scams.
You know what Mark Twain used to say are very wise words, that what we learn from history is that we never learn from history. I think it's almost impossible to divorce the two. Big money, there will be always people trying to make a quick buck. Even in Western markets, we had the Bernie Madoff scandal recently. $50 billion got vanished right under the nose of the SEC. So I think it would be perhaps too ambitious to think that we cannot have a scam. I think crooked people will figure out a way. So the advice always to give investors is educate yourself and caveat emptor, let the buyer beware.
Well, I have been saying to US investors that the reason why India does not have that kind of scams is because Indians are very cynical. And therefore Indians will not accept somebody telling you that this is my NAV without it being calculated by a third party and without there being some support of that.
And then there was Satyam.
We have followed corporate governance practices quite diligently.
The Satyam episode brought home the fact that most times corrections were unforeseen. But there were other trip-ups we faced, like the sudden and dramatic move by the government in 2007 to ban participatory notes into India.
We are not in favor of banning participatory notes, and we have not banned participatory notes.
Now that's a controversial topic, right? But my view on regulation has been this, that we have to take a clear view on where we stand on things like P-notes, and unfortunately in India there is no clear view that you can hold out on these things for the foreseeable future.
P-notes come via 15 to 20 P-note issuers, and although the Indian system may not know, those 15 to 20 P-note issuers have big businesses in India, and you can ask, that is the regulators can ask for as much control and data as they want via the issuers. So we honestly panic about the fact that P-note money is non-transparent, whereas the money raised via direct FI is transparent. I don't think that is the case.
This is a complicated issue because if we look globally, there are almost no markets left in the world which do not allow a reasonably open access regime to foreign investors. At the same time, things like KYC, know your client, or PMLA, money laundering, those are issues for every nation on earth. So they happily coexist with an open access regime. I think we will have to gradually master that art as well.
A move that was pulled back within a year.
The board reviewed the entire position and it said that the entire FII structure needs a review. But in the meantime, the curves were no longer considered necessary.
We have had access to the markets for foreign investors slowly being withdrawn, slowly improved, and the barriers to entry withdrawn. I would obviously like completely free access to the Indian market.
It was a market that stunned even the biggest bulls with the ferocity of its strength. In 2007, the market saw its fastest 1,000-point rally ever, a sum total of 4 days. But the breathtaking run was set for a fall.
The financial landscape changed forever. Lehman Brothers, gone. Merrill Lynch, sold. And titans like AIG and Citi effectively under government control.
A fall that brought the bull crashing to its knees.
Look, the fact is that any boom will be followed by a huge bust, because all booms will create excesses in the area where the boom is centered. So what happened in 97, 98 was a resultant of a big asset creation boom in the Far East, in East Asia, and especially the Asian tigers at that point, which was the Malaysia and Singapore and Taiwan, etc., South Korea. And then, of course, that mess got cleaned up by way of the emergence of the US tech sector, which began its journey upwards, around 98. So that took up the slack for the world. And then that, of course, as we all know, went completely overboard, including our own tech stocks. We started trading at 200 times, 400 times earnings. That was again something that, pretty much was preordained that that boom would end badly, and it did. And then the dollar trade started in 2002, 2003, when the dollar started to weaken sharply against all currencies, and then money from the US started to come out into emerging markets. That inflated commodity prices because of the weakening dollar. Commodity prices rising are generally good news for emerging markets. And then you had somewhere in the background was a problem building up in the US of a lot of cheap credit being shoveled into very, very suboptimal borrowers, and who went out and bought houses that they couldn't afford. And then the rest is history. And I think the third one really has been far, far more serious than the first two, because the fact is that the US has been the growth driver of the world, and it probably marks the end of the dominance of US as a huge superpower on the economic front. I think the third one was the real game changer.
I don't think anything prepared us for what happened in 2008, a synchronized global bust that took place. And for those dark days in October, it actually seemed like the world was coming to an end, that the capitalism system that we all love and cherish and want so much for a better future was in serious, serious doubt, and clearly it rattled everyone. I think nothing prepares you for that kind of event, but it always sobers you that financial markets are such risky places that even people without leverage or without putting money in bank accounts, safe deposits, can expose themselves to a tremendous amount of risk. And the importance that we do need regulators, we do need a government, we do need people overseeing the quality in the marketplace. By far, the thing that rattled me the most in that decade, and there have been lots of booms and busts in this decade, but the one was in 07, 08. It really was an eye-opener.
Let's take a break on that note. When we come back, Dalal Street's volatile relation with politics and the debate of the decade, decoupling or recoupling.